Nvidia has been one of the biggest winners of the AI boom, helping power the rapid growth of artificial intelligence while delivering remarkable returns for investors. But after such a massive run, many people believe Nvidia's future growth is already priced in. What if the market is still underestimating what's ahead? Hey everyone, welcome back to the Everyday Investor. I'm Austin. Today we're talking about Nvidia. Over the past few years, Nvidia has become one of the biggest winners of the AI revolution. But as expectations continue to rise, so does the debate around how much upside is still left. So is Nvidia still being underestimated by the market? Let's take a closer look. First, we need to rethink where Nvidia is today, because a lot of investors focus on the stock's massive run while overlooking what's happening underneath the surface. Even as one of the most valuable companies in the world, Nvidia is still growing at an impressive rate, and that's a big part of this story. As we move through 2026, Nvidia's stock continues to trend higher, which is rare for a company of this size. The real concern isn't whether the company can keep growing, but whether that growth can continue to exceed expectations. When a company delivers extraordinary growth year after year, investors naturally raise the bar. That means even strong results can disappoint the market if they fail to surpass the highest expectations. At the same time, some semiconductor stocks have recently outperformed Nvidia, leading some investors to question whether the company is losing its edge. But short-term stock performance often reflects market sentiment and capital flows more than long-term competitive strength. If we focus on the fundamentals, Nvidia still generates strong revenue growth, industry-leading profitability, and exceptional cash flow. So the real question isn't how much the stock has already risen, but how much value the company can still create going forward. Now, strong industry demand alone doesn't fully explain Micron's recent price action. The really interesting story starts in the options market. At first glance, Micron's put-to-call open interest ratio appears bearish. Many investors would look at that number and assume traders are positioning for downside. But when you break down the institutional activity, a very different picture emerges. A large portion of that activity appears to come from institutions selling deep out-of-the-money puts. That's important because put sellers are typically willing to buy shares at lower prices in exchange for collecting premium. In other words, they're not betting on a collapse. They're using options to establish bullish exposure. So what looks bearish on the surface may actually reflect institutional confidence underneath. This is where institutions and retail investors often see the market very differently. Retail investors tend to focus on the headline number. Institutions focus on what's actually happening behind that number. And sometimes the same data can tell two completely different stories. But put selling isn't the only thing worth paying attention to. According to data from Market Chameleon and Barchart, institutions have also been aggressively buying deep in-the-money call options. Some of the largest trades have involved strike prices around $500, $530, and even $700. That's not a common strategy. Deep in-the-money calls behave much more like stock ownership than traditional option speculation. They offer high delta exposure while still providing leverage. For large institutions, it's an efficient way to build a sizable position. And when large amounts of capital start using the same strategy, the signal often becomes difficult to ignore. These aren't small speculative trades. They're structured positions built by investors making a deliberate statement about future expectations. And when more institutions begin making the same bet, it's usually worth paying attention. To me, the most important part isn't the option itself. It's the fact that institutions are putting real money behind their view. Because at the end of the day, markets aren't driven by stories. They're driven by capital. That doesn't mean everything will go perfectly. This is still a massive infrastructure build-out. We're talking about well over $100 billion in investment, and the benefits may take years to appear in the financial statements. The broader economy also matters. If global advertising demand weakens before AI efficiency gains fully materialize, profit margins could come under pressure. There are also risks around chip development, deployment timelines, and execution. So this is not a risk-free story. But in my view, the biggest risks are about timing, not direction. For long-term investors, the hardest part often isn't identifying the trend. It's deciding whether you're willing to wait for that trend to play out. And that may be exactly where Meta stands today. But after considering all of these risks, there's another question worth asking. Has the market already priced them in? Based on today's valuation, the answer may be yes. Compared with many other mega-cap technology companies, Meta's valuation remains surprisingly reasonable. In other words, investors appear to have already discounted many of the concerns surrounding higher spending, margin pressure, and longer payback periods. And that's exactly what makes this situation so interesting. The market is focused on rising costs, lower near-term margins, and delayed returns. But long-term investors may be looking at something very different. If Meta successfully lowers infrastructure costs through MTIA while improving advertising efficiency through AI, today's spending could ultimately lead to much higher profitability. And once capital spending peaks and cost efficiencies begin to emerge, the market's perception of Meta could change dramatically. In that scenario, what investors fear today could eventually become the catalyst that unlocks future value. To me, the real story isn't how much Meta is spending today. It's whether those investments can drive higher efficiency and margins in the future. The market sees costs. Long-term investors may see opportunity. If Meta delivers, today's concerns could become tomorrow's value. What do you think? Let me know below. I'm Austin. Thanks for watching.